Joining us now is Emily Roland, co-chief investment strategist at Manulife, John Hancock Investments. Whenever we talk to you, Emily, and welcome, we always point out that maybe your fiduciary responsibilities at a place like Hancock, you're not going to recommend the Russell 2000 or whatever or high-flying tech stocks. But just overall, what's the state of the stock market in terms of valuation and the prospect for corporate America in 2026?
Yeah, Joe, the earnings engine in the United States is on. Analysts are expecting 8% earnings growth this quarter. So the bar there is pretty manageable. And there's a number of tailwinds in place. You've got lower rates that are coming through the pipeline this year. You've got lower taxes as it relates to the one big, beautiful bill. A weaker dollar should help U.S. companies. 40% of the revenues of U.S. companies are derived from overseas. And then you've got falling oil prices, which helps the transportation costs of some of these companies. So while we're not expecting a ton of multiple expansion at 22 times forward earnings, we do think that the U.S. continues to have the most powerful earnings engine of any companies around the globe.
Well, aren't you really forecasting a little bit of multiple contraction? What is your earnings per share or earnings growth estimate? I think in your notes it's 14% or so. So you're only looking for the market to advance in single digits, high single digits, 6 to 8%. So that, I'm not a smart man, but I'll know what love is. But I know that 14% is not 6 to 8% if multiples stay the same.
Yeah, you're very good at math, Joe. And that's right. We could see a touch of multiple contraction here. The market really has been driven from that multiple expansion. So we want to think about that. And you want to be selective in terms of where you're investing. This market has been about technicals. It's been about momentum. It's been like trade first and ask questions later. You've almost had to sort of remove macro analysis from your brain over the past year and just follow charts. We think that fundamentals are going to be back in the driver's seat in 2026. So you want to look for quality. You want to find it at a reasonable price. You want to look for companies that are really seeing benefits from productivity enhancements, that are better at managing their margins. And we think that active management is going to be, critical in this upcoming year.
I love when someone in the business of recommending stocks says, you know what, this is going to be, you're going to need the expertise of bottoms-up analysis, not top-down, which is also actually what I happen to do. What is it? What do you like then if it's a stock picker's market, Emily?
Yeah, we still like parts of tech. I think the challenge there is that tech's just been an asset allocator's dream return driver. You look at tech, it's expected to see 28% earnings growth this year on top of 25% last year. It's 34% of the index. So we're still overweight there, but we want to think about diversifying from that. Our favorite cyclical sector is industrials. We're seeing major CapEx initiatives pervade the United States. Again, the one big beautiful bill helping with that. We think industrials, even going down in cap to mid-cap industrials, can be a big beneficiary there. We're finding value in sectors like healthcare. We're sprinkling in a little bit of utilities there as well as an AI play. So we do expect to see more breadth across markets this year. We would look to go down, not all the way to small caps. There's lower quality there, but we think there's an opportunity in mid caps, which are still trading at about a 30% discount to their large cap counterparts. We would have a little bit of international as well. What we're seeing in the midst of this geopolitical uncertainty is it's showing up in the currency markets. We're seeing the dollar sort of lose its risk off appeal here. The euro has become a destination for capital. That helped non-U.S. equities have one of their best years in modern history last year. While they don't have the earnings prospects that we have here in the United States, they do offer currency diversification. So we would look to have some positions internationally here as well.
The deficit's coming in a little, but we're still going to hit, I don't know what we hit first, the semi-quincentennial, what is semi-quincentennial?
Quincentennial.
I don't know what we hit first, 40 trillion or whether we hit the 250-year anniversary. But does the bond market ever get more nervous than it is right now about that this year?
Yeah, I mean, you sort of saw bond vigilantes sort of perking up again towards the end of the year, sort of like that uncle that comes in and disrupts the good mood at the holiday party. But what we're seeing is some value, frankly, in bonds at these levels. Bonds to us are not sniffing out the disinflation that's coming through the pipeline. We'll be watching CPI, of course, closely tomorrow, and shelter has been the biggest component that has driven those measures higher. The BLS is telling us shelter is something like 3.5 to 4%. If you look at real time measures of housing, it's close to flat. So we actually think that inflation is not a significant issue for the Fed. It's really more about the labor market this year. And if inflation can come down and the bond market starts to sort of, shake out of it and pick up on that, we think yields can move lower over the course of the year. Money market yields probably get chopped down. That's been the most popular investment by far over the last couple of years. We actually see more value in the intermediate
Okay.
part of the curve, and we would look to lock those yields in.